In today's video, we're going to break down what a fair value gap is and how it can be applied when planning your trade entry. Let's dive in, but before we continue, if this content adds value, be sure to hit that like button, and if you're joining us for the first time, don't forget to subscribe and enable notifications so you'll always stay updated with our newest uploads. So, let's first define what a fair value gap actually is. Whenever market price moves out of its equilibrium zone and shifts quickly from one level to another, creating large candles, it reflects a price imbalance. In the chart example on the left, because there are more buyers than sellers in that region of the market, the distance between the two widens. As this gap widens, buyers accept higher prices, which strengthens buying pressure in the market, pushing prices upward rapidly. Likewise, when sellers outnumber buyers in the market, they are ready to sell at lower prices, which increases selling pressure around that level, driving prices down swiftly. In simple terms, when sellers are fewer and buyers are dominant, buyers take positions at higher prices, fueling buying pressure and causing the price to climb fast. On the other hand, when sellers exceed buyers, they offload at lower prices, building selling pressure and forcing prices to drop quickly. Market prices swing between equilibrium and disequilibrium in this way, forming different chart structures on the screen. When the market initially breaks out of a consolidation zone, if buyer activity rises, the price breaks upward. At that point, many sellers have positioned their sell orders here. So as soon as price touches this level, those orders get executed. But often, if price action trades near its lowest points, large groups of buyers enter here, pushing the price upward. Still, if the seller count is lower than buyers willing to purchase, sellers who had placed sell orders below the level shift their orders upward, compelling buyers to transact at higher prices and forcing the market to rally rapidly. This shift generates an imbalance or gap in pricing. We can clearly spot this between two candles because buyers stepped into the market at a level above its fair value. They accepted a higher entry, and that is why we refer to it as a fair value gap. Now that we've explained price imbalance or fair value gap, let's move forward and see how to mark it on charts. If a candlestick pattern like this appears on a chart during an uptrend, we should mark 3 candles from bottom to top in such a way that if we place 2 lines, one near the closing of the first candle and another near the opening of the third candle, we will notice a visible gap. This gap is referred to as a price imbalance or a bullish fair value gap. Likewise, during a bearish trend, we draw lines at the closing of the first bearish candle and the opening of the third candle. Here too, a gap will emerge, and this is called a bearish fair value gap. However, in bullish movement, if the closing of the first candle is lower but its wick extends higher than the closing, then the line should be drawn from the top of the candle wick. Similarly, we will draw another line from the bottom wick of the third candle. If a gap is created between these 2 lines, then we consider it a valid fair value gap. But whenever the market creates price balance by giving equal participation to buyers and sellers, and no gap exists between 2 candles, there will be no fair value gap on the chart. In this situation, we call such market activity balanced price action, as no imbalance is present. Also, in many cases, after a large bearish red candle forms, if the next candle opens and closes entirely within that red candle, creating an inside candle, then we must treat the first red candle as candle number 1 and continue numbering from there. Now, if we draw 2 lines from the highest point of candle 1 and the lowest point of candle 3, the gap that forms here is recognized as the fair value gap. Therefore, when an inside candle develops on the chart, always pay attention to the high and low levels of the master candle and draw the fair value gap accordingly. Otherwise, many traders mistakenly draw the gap using the high and low of the inside candle, which is incorrect. Similarly, in price action, if an inside candle appears within the master candle, we should draw 2 lines from the lowest point of the large green candle to the highest point of the third candle to illustrate the fair value gap on the chart. This must be marked precisely. At times, several small inside candles may form within a large candle on the chart. Even in this case, the fair value gap should be drawn considering the highest and lowest points of the master candle. Only when you apply this method properly while plotting the fair value gap will you achieve strong results. Let's now move forward to identify which fair value gaps are valid and which are invalid. Number 1. A fair value gap must remain unmitigated. When the price creates a fair value gap on the chart, the market usually attempts to move in that direction once to fill it. After the gap is filled, the trend continues as before. This means the price utilizes that gap only a single time. Therefore, a fair value gap is considered valid until it is untouched, meaning it has not yet been used. But once the price fills a fair value gap, it becomes mitigated, which increases the likelihood of future losses. In such cases, it is of no value to us. That is why a fair value gap is applied only once. And if it is mitigated, we disregard it going forward. Number 2. Candle closing within a fair value gap occurs frequently in the market. Sometimes, price reaches a fair value gap zone and breaks through it without respecting it, leading to the candle closing outside the gap. When this situation appears on the chart, it signals an invalid fair value gap, which cannot be used again because the price closed beneath that zone. As a result, we cannot take a trade in alignment with the previous trend. However, if price forms a long lower wick while dropping into this gap, and the candle closes around or above the 50% level of the gap, then we can treat it as a valid fair value gap and prepare a trade entry in the trend's direction. This is because price faced resistance when moving below the area, and the zone still holds the potential to reverse the move. The market swept liquidity beneath through the candle's lower wick, which raises the probability of price resuming toward its earlier trend. Number 3. Use the 50% area for larger candles. Sometimes, when the price in the market consolidates in an acumen zone for an extended period, the breakouts that follow are very strong. The appearance of large candles on the chart also expands the size of the fair value gap. In such cases, you cannot wait for the price to drop to the bottom of this area, because the market often reverses either from the starting point of the fair value gap or from the 50% area, causing you to miss the trade entry. For this reason, if a fair value gap forms on the chart due to a very large candle, you can place your trade entry near the starting point of the gap or around the 50% level, which also reduces your stop loss. If you enter at the starting point of this candle, your stop loss must be placed below this area, and that larger stop loss can damage your risk to reward ratio. Since in options trading you must maintain at least a 1 to 2 target. Entering near the 50% area gives you a tighter stop loss while preserving the proper risk to reward balance. Remember, if a bullish fair value gap forms on the chart, your entry point should be above this area. That is where you plan your bullish trade entry. If a bearish fair value gap forms, your entry point lies below the area, allowing you to plan a bearish trade entry accordingly. Number 4. Identify a valid break of structure. Whenever price moves downward after creating a valid break of structure on the chart, the probability of it bouncing back upward is very high. This happens because the market has already triggered the stop losses of retail traders who entered after observing the breakout, and in the process, liquidity swept their stops. As a result, price can find support at that level and continue along its previous trend. Therefore, when price moves into the fair value gap after a valid break of structure has formed on the chart, it provides a high probability trade entry setup. Number 5. Pay attention to other key factors on the chart. To identify a high probability trade entry setup, you must look for multiple confirmations before entering. Only then can you avoid getting trapped in the market. For instance, here, after forming a valid break of structure, the price moves downward and triggers this stop loss area. As price approaches the fair value gap zone, we cannot rely solely on one fair value gap to make a reversal entry. But if a prior support level is present near that zone on the chart, the likelihood of a price reversal becomes much stronger. You should also observe the candlestick pattern that forms in the fair value gap region. If a rejection candle with a long lower wick appears, it signals a bullish setup based on price action. Therefore, it is essential to factor in multiple elements before executing a trade. Let's now review some examples of fair value gaps on charts. This is a 5-minute timeframe chart of Nifty 50, where the price, after consolidating in a range, breaks below with a strong bearish candle. If we mark the last 3 candles in this sequence, a large fair value gap, or price imbalance, appears between the low of the first candle and the high of the third candle. We will mark this zone and wait for price to revisit it. After some time, the market gradually moves upward and re-enters the area. At this point, we can take a bearish trade because a bearish fair value gap is present on the chart. For this trade, our stop loss should be placed either just above this fair value gap or near its base. with the bearish candles serving as the starting reference. Shortly after, the price rejects this level, declines, and reaches our profit target. On the same day, the market rises from the bottom, breaks the previous swing low, and closes higher, creating a valid change of character. Now, we examine whether the price formed any fair value gap during this move upward. From this point to that level, only one valid fair value gap is visible near this zone, and it is quite small. However, many retail traders incorrectly draw a fair value gap near this bullish candle. This is wrong, because these three candles closed inside the larger candle, making them inside candles. Therefore, if we attempt to mark the high of this green bullish candle and the low of this candle, no fair value gap exists here on the chart, and so we cannot consider it. The valid fair value gap that did form is located near the same area where the market previously created resistance and dropped. Now this resistance zone can act as support for us here. Since our fair value gap is small, we place our trade entry near the last swing low, keeping our stop loss close by. After forming price action like this, the market takes support from our fair value area and moves upward. Notice here that the lower wick of this red candle swept liquidity below, while the closing of this candle occurred inside our fair value gap, confirming that a valid fair value gap was present. Therefore, before entering trades solely on the basis of a fair value gap, we should also consider the prevailing market trend along with the support and resistance levels visible in price action. Doing this minimizes the chances of trade entry failure. That's it, traders. Thanks for watching the actions you take today. Watching this video was a step forward, but the real progress starts when you apply what you've learned. If you gained value here, smash the like button. And if this is your first time, subscribe and hit the bell icon, because you don't want to miss what's coming next. Keep investing in yourself, keep leveling up, and I promise, you'll see the results. I'll catch you in the next video.